Hey Brew Crew, Brewer here with a PSA on the popular ticker DKNG, that's DraftKings. I've been brewing this idea for a bit today and thought I'd share it with you guys as a potential options play for this coming week. Now, I know I didn't include it as part of the weekend analysis video, but I think I'm going to be making more videos like these in sort of an ad hoc manner where I just share potential trade ideas that I find while looking at charts. And if I do take it, I'll share it in real time on Twitter and Discord and also update the trade spreadsheet to reflect that new position. So if you haven't yet and you're interested in getting notified when I do place trades, go ahead, check those links out. They're in the description below. So on with the trade idea, which you will need a margin account to do. I was looking at the chart of DraftKings and I noticed just how bullish the price action has been. I really like how the stock bounced up from the prior low and clawed itself back up above the 20 MA. I also do like the sideways action here that shows that prices are consolidating in this flag pattern, so that's another bullish signal. And switching over to the profile, I love how on Friday we spent a majority of the time up here, which if we switch back to the regular chart, is basically the top of this flag or consolidation range, which is always good prior to a breakout because it just makes the shorts even more nervous. So seeing these things develop, the degeneracy within me wants to bet on something to the upside for this week. If, and this is a big if DraftKings decides to actually make a run this week, I'm thinking that it will first target the trendline resistance up here near $41 before continuing any higher. And if it does show even more strength, then the all-time high near $45 would be the next target. So how do I want to construct a trade that can take advantage of this move without risking too much debit in case the stock doesn't have an explosive move to the upside by the end of the week? Because I really don't want to lose any money at all if the stock decides that it just wants to hang out sideways or drip a little bit lower. First, since I'm looking to target this trendline resistance by this coming Friday, I'm looking to buy a call option near that area. So the 41 strike call sounds good. So coming over to the trade tab, I can see that the 41 call expiring this Friday is currently going for about 85 cents, which is a bit too much of a debit for me. I'm a pretty cheap guy when it comes to these degen plays. Anything more than a nickel, and I'm losing out on a decent coffee, okay? So the next thing I'm going to do is look to offset this debit. And I know that the subsequent potential target, if we break that trendline resistance, would be the all-time high near $45. With that in mind, I can look to sell a further out-of-the-money call option that still allows me to capture a relatively decent profit if we move up there, but can also help offset the debit from the 41 call. So maybe I can sell something like the 44 call, which is currently going for about 40 cents each. So at this point, I have one long 41 call and one short 44 call. And as you can see, now my debit has gone down from 85 cents to now 45 cents. Not bad, but it can be cheaper. At this point, I think it's probably going to be unlikely that DraftKings actually makes new all-time highs this week, which means I think it won't go past $45. If I think it won't go past $45, then what I can do is actually sell another 44 call to knock down that debit even further. So here, I'll sell another 44, because now if DraftKings does expire this week at $45, this 41-44 call spread or call vertical will be worth its max value of $3, while the extra 44 strike call will be 1 point in the money, which will be down $1. So overall, I'll still be up $2 on the spread. And again, I think that the odds of DraftKings ripping very high up to $45 by this coming Friday isn't very likely. Of course, anything can happen, so I don't know for sure, but that's just my hunch. So now I'm long one of the 41 calls and short two of the 44 calls, which brings the debit down to 10 cents. But I want to be cheaper than that. I want to make this a cost-free trade that can still benefit from a little directional move to the upside. So how else can I knock this debit down to zero, or perhaps even take in a credit? Well, since I'm already naked short a call up here at 44, I won't really be taking on extra margin if I short an option on the put side. So coming over to the put side of the options chain, all I'm looking for here is a pretty far out of the money put that can give me enough buffer if DraftKings decides to tank. The 30 put is currently going for 10 to 15 cents. So if I add a short 30 put to this spread, now I'm essentially long the 41-44 call vertical in conjunction with shorting the 30 put and the 44 call, aka a short strangle. So now the trade looks something like this, and I am now receiving a 5-cent credit for this trade. Now by selling this naked put, I have new risk on the downside. So one thing I want to make sure of is, does selling this put make sense from a technical standpoint? So looking back at the chart, If DraftKings actually tanks, I want to give myself enough room to see if DraftKings can hold support. And if it doesn't, I want to be able to get out of the put before it goes really badly against me. I'm thinking that a close below either the 20 MA or Friday's low, whichever one happens to be lower, because remember the 20 MA is dynamic as the week develops. Whichever one is lower would be my signal to just buy back the put if we get a close below that. Ideally, we close the put at a small loss. The 20 MA would be around 34, and with not a lot of time left until expiry, the 30 put should still be relatively cheap to buy back. If I wanted to be more aggressive, I could sell a higher strike put to collect even more of a credit, but the downside risk picks up a lot faster. So I'm comfortable here with just selling the 30 strike. So that's the downside risk. Now for the upside, we do have unlimited risk if DraftKings goes any further than $47 by expiration. Our trade will actually start to go negative. But understand, for that to happen, the stock has to first travel through 41 and then 44. And by then, I'd already be looking to manage the trade and lock in profits before it goes any higher. So barring any sort of overnight risk that shoots the stock past $44, I feel pretty comfortable knowing that the trade has to work in my favor first in order for it to then go against me. So the max value of this entire spread is achieved if DraftKings expires on Friday at $44, which yields roughly $300 in profit per spread. But even if it doesn't reach $44, let's just say it reaches $41 instead by Friday, or even Thursday or Wednesday. Those 44 calls are going to be pretty much worthless, while the 41 call is going to retain its premium a lot better and may be worth around 75 cents to $1 or so. If that's the case, I'll be looking to progressively harvest those profits as they come, and I'll be doing so throughout the week if I play multiple spreads. So anyway, I like this trade. If DraftKings does see an explosive move higher this coming week, I'd love to get paid and manage the trade over the week while I grab myself a coffee with the credit received and hopefully be able to sell the spreads back out for a decent debit. All right, so that's it for this trade idea. Let me know what you think in the comments below. And again, if I do end up putting on this trade, I will share it out on Twitter and Discord. Until then, stay safe, Brew Crew, and I'll see you in the next video. Cheers.